Hello, it's Jack here at System Trader, and in this video I will talk about how to build a passive portfolio. But before we will go into the details, a few assumptions. First of all, we are not going to talk about active portfolios, or in other words, we are not going to talk how to beat the market. Not because it's not possible, but it's because it is very, very difficult. And in general, passive investing, static portfolio is a recommended form of investing to most of us. Another thing is that although the portfolio I will show and the portfolio you can build is very simple, or maybe very simple, or should be simple, as Warren Buffett says, investing is simple but not easy. Okay, so the only thing we can control is that we cannot control the markets, but we can control, for example, the costs. Therefore, we should keep them as low as possible, and this kind of portfolio will allow us to do it. Just a quick example of a passive or static portfolio we can see on the screen in my software, System Trader, which you can get at my website. And 60/40 portfolio, as the name implies, is built of two asset classes. We have S&P 500 stocks, 60%, and we have 40% of bonds, 10 years bonds in this particular case. And this is just the most popular portfolio you can imagine, or you can find, you can build. But let's try that we want to design our own portfolio, meeting our own, let's say, requirements. So we click in Home menu, Add, and Pie Chart Investing here, and we see a small pop-up window. First of all, we can set the benchmark. So let's say that the benchmark is, as you can see all these explanations here, it's just another investment in to which we will compare our portfolio. So let's say that we want to compare our portfolio to a simple S&P 500 index. And if you click on these three dots here, you can select the System Trader. This is a built-in symbols group in which you have a set of built-in data. And here we can just select S&P 500. Okay, now inflation. If we want to adjust our during simulation our portfolio returns, we want to adjust it by inflation, then we have to set the inflation as well. Again, System Trader group, and then we can just enter CPI, which is Consumer Price Index, and that's it. Okay, so we are set here. Now, currency, let's keep it American dollar, and let's start with $100,000, right? Okay. Now, here is the thing which says to the application how often we want to perform so-called rebalancing, which means that if we set our portfolio having 60% of stocks and 40% of bonds, we want to design the rule which will say when we want to make an adjustment to the portfolio if these weights will just deviate from these original values. Let's say that at some point our 60/40 portfolio would become 70/30. And let's say that at that point we want to sell stocks to keep them again 60% and buy bonds to make them 40% again. So let's say that we want to every year, so just once a year, we want to make these adjustments no matter what happens. So basically we can put zeros here. If you want to read the details about this, you can find all the descriptions you need here. I just want to keep this video short. But basically what we are going to do is that every year, at the end of the year, we want to, on the last day of the year, check the portfolio and keep these weights in its original values. The transaction costs we will put here on the level of the tariff from Interactive Brokers. And now let's build our portfolio. So let's put some assets into it. So to make the portfolio, let's say, realistic, we want to invest into stocks, but not only American stocks, but let's invest into the global stock market, and therefore we want to put world stocks here. Okay, that will be the first component. And let's say that we want to keep in our portfolio 40% for stocks. Then let's say that we want to put also some gold. And let's say that we want to have 20% of gold in our portfolio. And now let's say that we want to put to our portfolio also some bonds. But again, rather than putting only the American bonds, let's say that we want to put some global bonds. And let's say that we want to have, I don't know, maybe 30%. As we can see, we have 90% already, but we need to put one more thing or change the weights here to make 100%. So let's say that on top of it, we will also add maybe commodities, Goldman Sachs commodity index, and let's make it just 10%. Okay, so now we have our portfolio built, and let's call this our test portfolio. Right, and save it, and here it is. We can see our test portfolio created here, and we can confirm that we have what we selected. So we have world stocks, or the stocks, the global stock market, 40%. This index doesn't include the emerging markets, so just to make you aware of it, that some of you may want also to add some emerging markets. Then we have gold, 20%, we have bonds, 30%, and then we have commodity market, 10%. Because we have gold, therefore there's no point to test that portfolio further than before 1970, because before 70s the gold was linked to the American dollar. Therefore there's no point to test the portfolio before 1970 if we have gold in it. So here we can put that we want to start our testing from 1970, and let's see what happens. Here it's asking us the question, do we want to make rebalance at the end of 2018 and 2019? So let's say that yes, and let's see on the results. Okay, here it is. And test portfolio, this column is giving us the results from 1970 till the end of 2019, and our benchmark S&P 500. And we had a starting capital $100,000, and at the end of 2019 it's $9.5 million. And as we can see, the benchmark simple S&P 500 index would give us much more, 15 million. But although, as you can see here, the compound annual growth rate is, the difference is just around 1%, but over 50 years time, that 1% gives a huge difference in the ending capital. As you can see, that's the compounding magic. So we can say that our portfolio is, in terms of the profit of the returns, is worse than the S&P 500. But let's see on the other aspects. Here is just the return after the inflation. So each year on average, our portfolio was beating the inflation over 5%. And here is the part which says that our portfolio is better on other fields than S&P 500. So in terms of the returns, our portfolio is worse, but the maximum drawdown, the worst moment for that portfolio was when the value of that portfolio decreased by 36%, whereas the S&P 500 was decreasing by over 50%. So this is a significant difference. The maximum drawdown length, in fact, here it's our portfolio again slightly worse, but just to keep you informed, I just built that portfolio just out of the blue. I didn't try to make it optimal or best looking. I wanted to show you the procedure of building the portfolio. And the standard deviation, which means that the portfolio volatility, our portfolio is slightly less volatile than the benchmark. And here we can see that over 50 years time, 40 years were winning years and 10 years were losing years. Okay, and now let's look into the details. Here we can see how our portfolio was looking just on the monthly basis, month by month. Each green field means it's a profitable month, and the red one is it's a loss. And we can see that on average our portfolio was behaving pretty well, but it doesn't mean that each year we are making money. And for example, in the dot-com bubble, 2000-2001, there were 2 years in a row which were losing money. In 2008, which was a very difficult year, global economical crisis, we were losing over 19%, almost 20%. And for example, the end of 2019, at the end of 2019, the year was closed with a profit of 19%. So all in all, the portfolio is for sure profitable, and we can see that here on the curve, equity curve. It's definitely not a perfect portfolio, but it's for sure not a curve-fitted portfolio, which is very important as well. And what is also very important is that this portfolio doesn't require any even we don't even try to beat the market. We just created a static portfolio, which we only check once a year, which will take us like a few minutes, just to make sure that these weights are on the original levels, and that's it. And although the idea is so simple, the portfolio is profitable, and as we can see over the years, we were profitable. The whole idea behind such a easy technically portfolio, because we can use ETFs for that, is that we can keep the costs very low. And in order to do this, we can implement such portfolio using ETFs. Just for the simulation purposes, I showed you the historical data, which is built into the application. But if you want to see how it works with the real data, with the real ETF, then although I will not do it now just to save time, you can go to the data menu, to the Yahoo, and you can say ETF import. And there you can select ETFs from whichever market you want. Let's say that we want to see ETFs listed on the American stock exchanges, and there you can just simply look for the ETFs you are interested in. For example, GLD, SPDR, gold shares, and so on. And then you can build your portfolio using the real ETFs, low-cost index funds. But I use the data which is built into the application, because ETF's history is very short, and it would allow us to test our portfolio only for the last 10, maximum 20 years. Whereas having the built-in data, we can test our portfolio for 50 years, even more for certain markets. Therefore, that's why I selected the built-in data. But you can simply mimic such portfolio using the ETF data, using data, Yahoo, and ETF import. Okay, that's it from my side. Thank you very much for your attention. I encourage you to download your copy of the software I'm presenting here, you can just visit my website at systemtrader.show/st and just simply give it a try. Happy investing. Bye bye.